Have you ever wondered how early investors turn small checks into life-changing wealth long before a company ever goes public? Private equity has long been seen as a closed world reserved for institutions, billionaires, and elite funds, but that reality is changing. Today, individuals with the right knowledge, access, and structure are increasingly participating in private equity, venture capital, and angel investing. These investments operate outside public markets, offering the potential for high yields, but also demanding a very different mindset from traditional investing. At its core, private equity is about owning pieces of businesses, not trading paper assets. Venture capital focuses on early-stage companies with high growth potential, often before profitability. Angel investing operates even earlier, backing founders at the idea or prototype stage. These investments are risky, but the upside can be extraordinary when a company scales, exits, or becomes an industry leader. High-yield deals in private markets are driven by asymmetry. Information is limited, liquidity is low, and outcomes are uneven. Most investments may fail or produce modest returns, while a small number generate exponential gains. This is why private equity success is less about individual deals and more about portfolio construction, patience, and access to quality opportunities. One of the biggest challenges individuals face is deal flow. Unlike public markets, private deals are not listed on an exchange. Opportunities come through networks, relationships, and credibility. Investment clubs play an important role here. These groups pool capital, share due diligence, and open doors to deals that would be inaccessible to individuals acting alone. More importantly, they reduce isolation and emotional decision-making by encouraging collective analysis. Accredited investor status often determines access. Regulations exist to limit participation to individuals who meet certain income or net worth thresholds. While this can be frustrating, it reflects the reality that private equity requires the ability to absorb losses, wait years for liquidity, and operate without daily price validation. Understanding these constraints is part of approaching private markets responsibly. Multifamily offices have become powerful gateways into private equity for individuals. These structures aggregate capital across families, providing institutional-level access to venture funds, private equity deals, and co-investments. Beyond access, they bring governance, risk management, and professional oversight. For individuals serious about long-term private investing, aligning with a family office structure can significantly improve outcomes. Capital raising is another side of the private equity ecosystem. Investors are not just deploying capital, they are participating in a network where relationships compound. Being known as a reliable, thoughtful investor increases access to better deals over time. Capital flows toward trust, not just returns. This relationship-driven nature is what separates private equity from transactional investing. Exit strategy is where private equity wealth is ultimately realized. Unlike public markets, exits are not guaranteed or predictable. They may come through acquisitions, mergers, secondary sales, or public offerings. Timing matters, but so does structure. Investors must understand liquidation preferences, dilution, governance rights, and exit waterfalls. These details often matter more than headline valuations. Private equity requires a long-term mindset. Capital is locked up for years, sometimes a decade or more. There are no daily price updates to validate decisions. This illiquidity is not a flaw, but a feature. It protects investors from emotional reactions and allows businesses time to grow without market pressure. Those who succeed in private equity are comfortable with uncertainty and delayed gratification. Risk management in private equity looks different. Diversification happens across stages, industries, and managers rather than across tickers. Investors allocate only a portion of their overall portfolio to private markets, balancing illiquid growth assets with liquid public investments. This integration is critical for long-term financial stability. Private equity for individuals is not about chasing hype or copying headlines. It is about developing judgment, building relationships, and understanding businesses at a fundamental level. The learning curve is steep, but the rewards can extend beyond financial returns. Investors gain insight into innovation, entrepreneurship, and how value is created behind the scenes of the global economy. For those willing to invest time, patience, and capital wisely, private equity offers a path to differentiated returns and deeper engagement with wealth creation. It is not easy, and it is not for everyone, but it remains one of the most powerful tools for building long-term wealth outside traditional markets. If you found this exploration valuable and want more insights into private investing, capital strategy, and wealth-building frameworks, make sure to subscribe to the channel, like this video, and share your thoughts in the comments below. Your engagement helps us continue delivering in-depth content on opportunities beyond the public markets.